Welcome to another video from gettechnicalstockanalysis.com. We're going to talk about one of the key elements of stock analysis, basis. How well the base is formed will give us a clue if the stock is going to perform well or not. Now to disclaimer. The content presented in this video are for informational and educational purpose only, to empower people to make a healthy, conscious decision of their own. It is important to do your own analysis before making an investment. The content provided on this video are based on individuals' personal experience with their investments in stocks. The video is not to recommend purchase or sale of any stock. The main goal of the contributor is to educate people of art of chart trading. What are bases? Bases are consolidations or sideways movement of stock after it had already made a significant gain or immediately after IPO. Before making another move, it is important to observe the trading volume as the stock forms a base and comes out of it. The left side of the consolidation should see reduction in volume as the stock forms the bottom of the base. As the stock builds the right side of the base, you want to see an increase in trading volume. Some stocks may form series of short consolidation as it completes the base. You want to see similar price action within those short consolidation as described above. Overall consolidation must be at a minimum 8 weeks. We're going to see two examples of bases, one bearish and one a bullish one. The first chart we're going to see is KEMET Corporation. It belongs to an electronic component manufacturing group and it had top fundamentals. The stock peaked in September of 2017 as indicated in point number 1. And the stock gave back gains next 6 sessions before it bottomed out. 2 weeks later, it gapped up on significant volume, but the bearish indicator was the stock gave back the significant intraday gains on the gap up day. That's not a good sign. And 2 days later, again, it gave back a chunk of change. See the volume here, it was like way above the average trading volume. Yet the stock kept making new highs and it kind of completed a deep 3-week cup formation. And note that the volume on those new highs were below average. Another bearish indicator is pointed by point number 6. The stock goes sideways and some people call it a churn. That's not a good sign. You see all those red indicators, candlestick, which is like stock opened higher but ended lower. And when the earnings was announced, it dropped like 40%. And if you can see, there were telltale signs of bearish base formation. We're going to see a bullish chart pattern with using the example of NUTANIX. NUTANIX belongs to enterprise cloud space. It started correcting right out of the IPO and it kind of went sideways for several weeks. And you'll see those long intra-week trading ranges. And then, as indicated by point number 2, the prices started tightening. And then the stock makes series of new short bases. Every time it thrusts forward, it was accompanied by huge volume. From July to October, it formed a nice cup and a handle formation. And eventually to break out in October, again on increased volume. Key consideration, ensure the base formation is at least 8 weeks long. Look for tight intraday trading range as it completes the base. Volume on the day the stock breaks out should be at least 50% more than the average volume. Handle should be at least 1 week. Always sell on technical indicator, even with stock with sound fundamentals. And that's a wrap from gettechnicalstockanalysis.com.